all these sectors and the economic growth that we are talking about, creation of 100 million jobs, will definitely require a large amount of capital. And one of the drivers that we have addressed is the issue of access to capital. How does one get capital that is required for creating 100 million jobs?
So I think we can see that availability of capital for what is visibly a need for the country is not that difficult. We have money coming in from outside, we have domestic savings. Much of our savings do not get translated into financial instruments, so we must have that system also in place where more and more of our savings get converted into financial instruments rather than get invested in gold and land and so on. So 30%, 32% savings rate in the country is not a bad rate. It can lead us to a 7-8% growth without difficulty. I think we need to augment that with inflow of capital from outside so that we can add to our growth rate. But by all means, the savings rate is not bad. We need to get more savings into financial instruments. So for that, we have to control inflation. It's a counterintuitive thing, but see, the fact of the matter is that why is there so much demand for non-financial assets? Some of these, like gold, have some ornamental value, but some of it is not intended to be ornamental value. It is also has a store of value. Now we must dissuade people, or through a market mechanism, from using gold and other non-financial assets such as land, etc., as a store of value. And that can happen only if people see that there is value in financial instruments that is protected even as they go forward, that it does not run down value. Our experience of the last 30 years, especially after 1973, when the first oil shock took us by surprise and we had rapid inflation thereafter, is that inflation eats away the value of financial instruments, typically the non-equity instruments. And therefore, we must have this inflation under control. And for that inflation under control, people must, or our regulators must think in terms of the long-term inflation rate and the long-term interest rate corresponding to that. After all, the interest rates capture inflation in that. So if we think of the 10-year government bond rate, which is currently at 7.2%, which used to be much higher, it has come down after Governor Rajan and the government of India embarked on this inflation fight. But we need to bring that down substantially so that the cost of capital for the user of capital becomes affordable. And for the saver, if that inflation goes down, then there will be incentive to save in financial instruments, saying that, okay, my value is going to be protected. I can afford to have an annuity in an insurance company giving me returns for my retirement. I don't necessarily have to invest in land or gold and think that that is the only way to preserve value. So more savings going into financial instruments. That's the first step. The second is creating institutional structures for flow of capital into risk assets as well as the lesser risk assets. So for instance, we need for research and development. Now research and development is long gestation, but we have just forced through government directive and action a huge obligation on corporates for CSR, estimated at about 25,000 crore rupees. This was done by an extra constitutional directive from the government that you have to spend on CSR. And though it is supposed to be comply or explain principle and you are supposedly allowed not to spend it, in practice everyone is spending it because you don't want to be caught in the government net. Now, can we find a way to increase R&D spend? Can companies be encouraged to spend on R&D for various objectives? They may have cost reduction as one objective, they may have new product development as another objective, they may have a new delivery system as another objective, or whatever they want, they should be allowed to spend. They should be allowed to cooperate. Give them some carrot and stick, as it were, for that R&D expenditure, so that ultimately a culture is created where innovation takes place, when new products are developed, where existing products or new products are made at cheaper and faster and better rate than in the past. So some R&D spend is required to give the opportunity. And once you come out with new products, there is disruptive manufacturing, disruptive technology, disruptive processes that will lead to creation of new entities that will try and address these markets created by the new products. As you see, again, as I said, in the mobile space today, we have had new companies come up and they've become reasonably large in terms of number of jobs created, in terms of their turnover, in terms of their marketing. So they are working exactly as could be envisaged when you think of disruptive new products or disruptive technology or even new products. So creating R&D. And the third, of course, is the institutions for that. Institutions, we are just seeing the beginning of an ecosystem for startups in the technology space. Startups in biotechnology do not have any support even now. Startups in the space technology, forget it. There is no real capital available. So how do we create that? This greater partnership between industry and universities and R&D centers is very necessary for that. And of course, then the marketplace acceptance. So we have to have the regulatory system that is ready to respond quickly. For instance, to say a drone technology that may make life very easier, not just for the farmer, but for geospatial uses and for monitoring law and order and so on and so forth. Now, can we work in tandem? These institutions, even if they exist, are not necessarily used to working together as an enterprise or countrywide or region-wide system. They work in isolation. We see it in the financial services business where SEBI thinks differently and RBI thinks differently. They sometimes cannot get their act together. SEBI completely is independent of government in terms of ease of doing business. Government talks of ease of doing business, but that message is not reached down to SEBI. So we must work together in creating the right regulatory environment and, of course, the right technology drivers as well as the right commercialization angle from the existing company. Now, can there be systems created for this? We are allowing partnership, but we don't have the powerful incentive system for instance, the R&D houses. You have so many tens of scientific establishments on the government side, but there is not that commercial angle instilled in them. If there was a demand on those scientific organizations that they have to generate at least, let's say, 25% of their revenues from commercialization of their technologies, or some such kind of powerful driver from government and incentive for them to benefit from it as an institution, as individuals within that institution, we will see a lot more outcome of technology coming into markets in the domestic space from these scientific institutions that already exist. Individual companies that have created R&D centers, which were, unfortunately, many of them were basically R&D tax plays. You had a big tax break under Section 35, you got 200% and so on, which now government is seeking to take away. But that was the driver, not necessarily creation of a competitive advantage in the marketplace. So take away these tax breaks. Don't give tax breaks for R&D, but give the commercial advantage, and therefore make the product introduction possible, the quick-to-market product introduction. That, how does the government and the commercial establishments and the technology establishments work together to make that happen? So we need to have either standing committees, maybe some CII can organize this kind of approach in different sectors, whether it's in agriculture or biotechnology or space technology or whatever. We need clusters of these businesses, and not just one. There can be many, but the idea should be it should be replicated at state level, because we have overwhelming bureaucracy. What impedes our progress in India is bureaucracy, is the lack of rule of law, the lack of speed of decision making from government in response to new developments, and the cumbersomeness of even complying with things, whether it's in the financial service, again, we talk of these payment banks. Now look at the way they've been introduced. There are such severe limitations. They can only invest, for instance, in government securities. They cannot take deposits of more than 100,000 rupees and so on. So while the payment technology on the transaction side is extremely well developed, they can generate revenues. As a bank, as a payment bank, they cannot succeed because of these constraints from the regulator. So here is a classic example where regulator and the commercial establishments must work in tandem and in harmony for the service of the consumer at the end of the day. It is the people of India that will benefit from this cooperation, and regulators must be sensitive to trends that are emerging. They cannot be living in the past. They have to be ahead of the curve, or at least in keeping with the curve, in tandem with commercial establishments. So it's not going to be easy. The next stage is, of course, getting money from outside also. We must continue to be a haven for inflows of talent and capital from outside. That means the environment has to be hospitable to both capital and people. And I think government is recognized that. You see the new policy that if you invest a little bit of money here, you can get your permanent residency, you can work for 10 years, your spouse and dependents can work and all. Wonderful. I think we need to have this cross-fertilization of ideas. We may have talent within the country, but we don't have sufficient talent. And we can always do with more talent. There is no harm in having talent come from outside and help us, and while they help themselves in creating jobs here, in creating products here, in creating services here which meet our needs or needs of the world, as it were.